The good thing about being able to interpret and analyze financial statements is that you can see the relationship between different things. So, for example, a firm might have a really good return on investment or ROI, and that is actually a good thing, but it can also mean it's got a lot of debt. So debt can be a good thing on the one hand because it will increase your return on investment. So to demonstrate that, let's take two businesses. Business A has a net profit of 15,000 and so does business B. So they're identical from a profit standpoint. Look at their accounting equations. Both businesses have assets of 100,000. We'll say business A though has much more debt. It's got liabilities of 80,000 versus only 10,000 for business B. And that leaves owner's equity of 20,000 for business A and 90,000 for business B. If we were to calculate return on investment for each business, we'll get net profit for business A of 15,000 divided by assets of 100. Well, business B will be the same. The net profits of 15,000, the assets are 100. So for both businesses, the ROA will be 15%. So they can't be split based on a return on their assets in terms of profit. Can they be split in terms of their debt? And they actually can. So if we take the liabilities and divide them by the assets for business A, we take 80,000 divided by 100, whereas business B is only 10,000, and divide that by 100, and we get a debt ratio or gearing of 80% for business A, but 10% for business B. So we look at that and we say business A is far riskier, it's less stable, and it has much more, a higher proportion of every dollar of assets are financed with debt compared to business B. However, one thing you want to look at is how much equity do I need to put into a business in order to generate a return. So we can measure that with ROI. So to do that, we do net profit divided by owner's equity. So for business A, that would be a net profit of 15,000 divided by owner's equity of 20,000. For business B, that would be a net profit of 15,000, but the owner's equity is much higher, it's $90,000. And because of that, we're going to get an ROI for business A of 75%, but for business B, 16.7%. And the main difference here is we're dividing the same net profit by much different numbers. So for business A, its owner's equity is only 20,000, and for business B, it's 90,000. And that all comes down to debt. Because business A has so much debt, that leaves it with a very small amount of owner's equity. Business B has hardly any debt, which means it has a lot of owner's equity. So for all that equity, it's still only generating the exact same amount of profit as business B, which as a percentage means every dollar of capital for business B only earns about 17 cents in net profit, but for business A, earns about 75%. And what that demonstrates is that there's a classic trade-off between risk and reward. So if I invested in business A, it is very risky, but the reward for doing so is very high. However, if I invest in business B, I'm not going to get as high returns on my investment. However, it is far less risky and it is much more stable than business A. So to demonstrate those ratios and what they mean, we had a 15% ROA, which was simply the net profit divided by the assets, which was identical. The debt ratio demonstrated that liabilities were very different for these two businesses. For the ROI, the main difference here was the net profits were the same, but the amount of owner's equity for each business was much different. So when a business needs money to buy an asset, it basically has a choice. It can either, one, raise capital, the owner can contribute funds to the business itself, and the pros of that are that it doesn't incur interest, it doesn't increase the level of gearing. The cons are it's harder to finance the money because the owner only has a limited amount of money. And secondly, it's going to reduce my ROI. If I use equity to finance things, as in I use money that the business already has, that is going to actually lower my ROI. On the other hand, a loan actually does have some pros, and that is it's easier. We can go to the bank and borrow money, that's what they do, rather than having to try and find it ourselves as the owner. And secondly, we just saw that if I do borrow money, it will actually increase my return on investment. The cons of that are obviously that any loan or debt incurs interest expenses, and it will actually increase the level of gearing, which we learned that does increase our financial risk and makes us less stable.